Well, it's 75 basis points, good people. 75 basis points. We're just going to go right to CNBC and listen for a while, okay?
Down 20% in the S&P, down 30% in the NASDAQ, and University of Michigan at a 1978 low of 50.2. That pretty much summarizes the hurdles the Fed needs to overcome to get back into the popular graces.
And on top of that, and we turn Mike Santoli to you, the Fed is basically signaling here that from current levels, which we've already doubled, let's call it, in rates this year, we're going to double again. All officials projected rates rising to at least 3% by year end. Is the market already pricing that in?
Largely, Kelly, and I would say tentatively at this point, because really it's all about whether the bond market conveys the idea that the bond market is in tune with the new apparent path for the Fed, because that's the premise for whether stocks can stabilize. We're down 10% coming into today in 4 days in the S&P 500. It's oversold, but also on very slippery footing because of the instability, I think, in bonds. There's two-way Fed mistake risk is perceived out there, either over-tightening because all they're really doing is trying to attack gasoline prices, which they can't do. You know, you talk about Fed inflation expectations, and that was the seeming prod to go 75 this time. Inflation expectations in the University of Michigan sentiment survey is basically gasoline prices. So they're going after this one thing that they may not be able to affect. I think it's okay. Look, financial conditions have tightened a lot. Jay Powell in the press conference could choose to emphasize that. And he might also be able to say, well, you talk about our credibility. We've only just been a lot of words in the last 6 months. And look at what's gone on with mortgage rates, with high yield debt spreads and all the other things in stock valuations. We've kind of got a lot of this in the books already. Maybe we're sort of front loading it and you can see around the hill to when it's almost over.
And David Kelly, there are a couple hints of dovishness, if you want to call it that, in this decision. Interestingly enough, Esther George dissented in favor of a smaller increase. We tend to think of her as somewhat more on the hawkish side, but she only wanted a half-point hike. And the median Fed official sees the rate at 3.8% at the end of next year. And you could argue maybe the market had actually gone a little higher than that.
A little bit, but the markets moved very fast in the last few days, even as the Fed officials are putting in their forecast. So I think it was a given that the market was going to be a little higher than the Fed today. But I think it's really interesting that Esther George, who has, as you say, a long-lived reputation of being a hawk, recognizes perhaps that the Federal Reserve is about to make its typical mistake of waiting too long and then doing too much. And when it comes to credibility, it's really important they don't overdo this here, because I think that by the end of the year, they're going to have to be singing a significantly different tune. And I'd rather not see that, to be honest.
John, let me ask you to respond to what David just said, waiting too long and doing too much. John says that there are already signs of a dramatically slowing economy baked into the cake, and this is going to be the cherry on top, I suppose, and not in a good way.
Yeah, I think that's the risk. The Fed is clearly responding to last week's CPI print. That was higher than expectations. Prior to that, all the guidance had been for 50 basis points. You get a high CPI print. Now they're doing 75. The risk is CPI, at least parts of it, tend to be backward looking. The shelter components in particular reflect changes in house prices and rental prices that happened months ago. I think what we all know is what's happening in the housing market right now is substantially different than what was happening at the beginning of the year. Mortgage rates are higher. Every indicator of housing activity is turning. You saw that in the National Home Builders Survey this morning. Home sales, home starts. We're going to see a pretty sharp turn here. And so the risk is that they're responding to a backward-looking indicator in CPI, and those more forward-looking indicators do signal a turn in activity and probably in prices. And I think that generally is the risk that they face. So I just want to echo. I find Esther George's dissent interesting. I hope she'll explain that in a subsequent piece. That is a little bit unexpected. But I'm very much with David that the risk here is that they're responding to backward-looking indicators where the forward-looking indicators actually suggest something different.
Let me ask you, Mona, the Fed sees inflation at 5.2% at the end of this year and at something about 2.6% at the end of 2023. You think they can get that?
Yeah, I think all of my colleagues here have highlighted it really does come down to the inflation and inflation expectations. The Fed, I think, is reflecting what we did see this past Friday, where headline CPI came in well above expectations, and they moved that up to 5.2%. Interestingly, core inflation, of course, excluding food and energy, was lower, 6% in the CPI print, trending downwards. And I think that's reflected as well. I think they do think they can get 2.7% next year. Keep in mind, the Fed actions really do impact core. And two trends we've been seeing, one that John just highlighted, cooling housing market, but the other one is a potentially cooling labor market. We've already started to hear technology companies having layoffs. Over time, that will impact not only the unemployment rate, but the potential wage growth that we've been seeing. So as the Fed has been indicating, as we've been saying here, I think generally by the end of the year, we should see moderating inflation. And that will really be this cycle's Fed put. The Fed can then go at a more gradual pace. They won't back off until inflation starts to come back towards their 2% goal. But if they start moving at a more moderate pace, I think that's really when market sentiment can turn in a more meaningful way.
We've seen stocks give up most of their gains. Rick, we saw the Dow up 400 points earlier today. We were up about 100 going into the meeting. We briefly dipped negative. We're up 60 right now. NASDAQ still up 1%. This now, any comment on why we might be fluctuating more to the downside just in the last couple minutes here?
Yeah, I really do think as this sets in, we are going to continue to see interest rates be the antagonist in this whole play against the equity market. So, yes, if you look as the dust settles, we're slowly starting to climb back. There's more flattening going on than steepening with regard to the yield curve since the 2 o'clock decision was announced. And I really do believe that the Fed may be right in the projections of inflation. But therein lies the problem. Once again, what we have here is a failure to communicate. Even if the Fed gets these inflation numbers down to 2.5% or 3% by the end of next year, let's say, that doesn't mean prices are going down. That just means they stop going up. And I'm sorry, but I think many viewers, as they look at prices, whether they pay for milk or eggs or houses or gasoline, the fact that they've stopped moving up is definitely a positive. But it's about moving down that they're most interested in, and I don't see that on the horizon anytime soon.
Failure to communicate, I would say, Steve, failure to prognosticate. Let's look back to March when the Fed said 1.9% Fed funds rate at the end of this year. Now they are saying 3.4%. And as you pointed out not 5 minutes ago when you broke the news, 2023, 3.8% on the Fed funds rate, up from 2.8%. Those are significant changes in terms of the predictions.
Yeah, I think we started printing these SEPs, or Summary of Economic Projections, back in 2011. And I think you'd be hard-pressed to find a percentage point change in the outlook for the funds rate from one to the other. But, Tyler, maybe there's some good news in this, and I don't want Rick to have a coronary on this, but the market has been higher than the Fed for several weeks now. Maybe we're finally getting to some place where we can agree on what the next several months of Fed policy looks like. I will just say the market has pushed ahead the futures curve for the funds rate a little bit today, but the Fed was at 1.9, the market was at 4. Now the Fed's at 3.8 for next year and the market's at 4. So the gap between the market and the Fed is much lower. And the question you have to ask yourself, the only thing I think that matters from an investment standpoint is, do you feel like 4 is enough to get the job done, to take control of inflation? If we're at a place now where the market has correctly priced where the Fed is going, and by the grace of God, the Fed has unbelievably or uncharacteristically priced where it's going, and this is where the market is, it's not the worst of all outcomes here if we've digested a potential 4% funds rate.
So that's an interesting, and I think for a dumbass like me, an esoteric point, and you know, why not just say the truth here? Come on. At any rate,
I will dissociate myself from that remark.
In a practical sense, what does it mean that the market and the Fed may be actually approaching one another on where it means? What does it mean to me?
It means you don't have to come in every morning and have the market swinging by 300 basis points because it believes the Fed's going to do another 50 basis points next week or next month. It means if you can get to a place where there's some agreement on the outlook and what the task is at hand, we can take some of the volatility out of this market. And it means that if you're a bond trader, you come in the morning and you're not guaranteed to lose your shirt at the end of the day.
and the market has priced it in. Now, let me warn you guys. You could do whatever you want to do. Anything I say is not a suggestion for you to buy, hold, or sell. I'm taking this time to sit still. Now, there's going to be some people that will be short in the market. And if you know what you're doing, then you could go ahead and do that. If you don't try it, right? And there'll be people, depending on the stock, they'll be going one way or another, right? And so I will also caution you that today is going to be a roller coaster day. Now, the Fed, Jerome Powell hasn't spoke yet. He'll be speaking shortly here, and we'll discuss that tonight when we go live. So Fed Jerome Powell will be speaking. He's usually a little late. He'll say why they're going up. He'll give a forward. What's the word? Like he'll give a forecast of what's to come, and the market will react then. So even though we're still green now, we could end up horribly red. And what happens is it gets even worse most of the times when they start to ask the questions, the hard questions, and he gives you either a hard answer or a vague answer. He usually tries to give you a vague answer. And so just keep your eye on the market while he's talking today, good people. We've been through this too many times, right? Then what normally happens after that, today is Wednesday, right? So what is today? Yeah, today is Wednesday. So what normally happens after that, then you have these state by state Fed. They will start talking. All these loose cannons will start talking. The market turns even redder, because they're more hawkish than he is, right? Keep in mind, Monday is a holiday. The markets will be closed on Monday. So this will be a 3-day weekend after the Fed speaks. So I just wanted to prepare you guys for a very rocky week, right? This will be a very rocky week. Tuesday of next week should be very interesting. I'm going to look at a few comments and then we're going to call it. All right. So what's up, fam? How you doing, man? Love you guys. Get your popcorn ready. Yeah, you're right. Get your popcorn ready because it's going to be a roller coaster ride. Yep. Yes. The market already priced in 75 basis points. Had he gone lighter than that, I believe that the market would not have reacted as good as it's acting now, because the market has spoken. It wants the Fed to do what it needs to do so we can make this money, all right? And so that's what's happening, good people. I just wanted to come live with that so you guys could see exactly what's going on. Let's see here. Anything else that they're talking about right now? S&P, Fed boost, Fed boots. No, they're not talking about anything. So let's take a quick look. As we could see, let me refresh here. As we could see, still decent. Look, Dow's still up, S&P still up, NASDAQ still up. That's for right now, all right? That's for right now. So let's just see how this day is going to react, all right? So remember, keep all the information. Don't be anxious to make a move right now, right? Right now, I'm just going to sit still. What I'm going to do, I'm going to be cool. Just be cool. Let them do what they're going to do. And then we're going to make our plans accordingly, because from minute to minute, this market could turn on a dime. All right, good people. Tesla is running up hard. Is it? Yep. So I'll tell you guys, look, stay diversified is what I'm going to tell you guys. Stay diversified. I made a video yesterday. I want everyone to watch yesterday's video. I want everyone to watch it, okay? But I also want everyone that's listening to me, I'm gonna leave a link here. The video from yesterday, I'm gonna leave here. The video tonight announcing Stock Bowl, myself, Keen and Grace, and we're gonna have a special guest. I'm gonna leave here. I'm gonna leave it right there, good people. I love you guys. We're gonna watch what this market do. We're gonna make our moves, plan accordingly, and we're gonna continue to make money, all right? What's a good price to buy ETH? I could tell you right now, buy ETH at. I could tell you right now, I discussed it. We'll discuss it tonight. All right. I'm going to give you the answer to that tonight because there's levels of support that Bitcoin could come down to. Right. And I actually discussed that on the video, and those levels I'm going to leave in a box here. That video from yesterday, I discussed that. But tonight, we're going to explore that a little more. All right, good people. So that's it, good people. Hey, I love you guys. We're going to keep this going. Live love. Hey, you guys already know. Just check out all of the links below. Check them all out. All right. Love you guys. I'll see you in a few hours tonight live. Make sure you click this box. Okay. Live, love, laugh, and learn.